Right, hi folks. I'm now going to take you through the equity market, the place that's always the most exciting. You can make a bit of money over time, you can lose money from time to time, but we're very proud what we've delivered to investors over the course of the last 10 years of our existence. In summary, we're in a bull market and we've learned over time not to fight that. Bull markets can go on for much longer than is expected, and it's justified by valuations. And with the primary force being the stimulus being added by the Fed in the US, we expect this to continue. But we certainly, as Henry indicated, we're looking very carefully at valuations and where the world sits. If we look back on 2020, South Africa was basically flat from an equity perspective, with the financials part of the market suffering and still down as a result of COVID. Whereas globally, you got about a 15% return in US dollars. So we landed up in the year with a very interesting kind of picture, 35% down and then about 50% up. Our 2021 projections are positive returns from markets, and this is looking 12 months out, but we think markets could go a lot higher than the projections of 5% for global and 11% for local before leveling off and people taking some profits. The bull market conditions are certainly prevalent, but it's very important to understand that the market is priced for perfection. Valuations on a forward basis, so the MSCI World is about a forward 21p multiple, and that's about 30% higher than average. Some, for it to be a little bit above average is justified because earnings growth is likely to be strong this year and next year. But certainly, if things go wrong, there's a fair amount of downside potential. We make the point that all eyes are on Israel from a COVID and vaccination perspective, and I'll go through more of that. And emerging markets are currently pretty strong. So when the world is risk on and yields are low, people look beyond that to find investment opportunities. And you're seeing some quite nice flows into both equities and bonds. And hence you're seeing the South African markets, which has already given a pretty good return for the year. In South African portfolios, we've got a strong global portfolio positioning. And our view is with low GDP growth for quite a few years to come, that simply sitting on South African Inc. shares, buying and holding them is perhaps not a winning strategy. So we're being a lot more active, but there certainly are bottom-up opportunities to make money. Just to make a point in the South African market, and at a NASPERS conference call a few weeks ago, they pointed out from a value point of view, if NASPERS continued to grow its earnings at 20% plus per year for the next few years, and it traded at its NAV, it would be 60% of the South African market. So that's just one to keep an eye on, and it's especially important for the index return. It's also a good reason why South Africans should diversify globally. And in fact, if you look at our equity fund, there's quite a bit of global exposure. So what were the equity market lessons in 2020? Number one, everybody can be wrong. All of these presentations right across the market in January last year got it completely wrong because black swans are real and the unexpected can happen. So what does that mean? You've got to diversify your portfolio and you don't know what's coming. It's hard to predict. You've got to back long-term trends. And what we saw in 2020 is as things went awry with COVID, the long-term trends of e-commerce and the like certainly shone through and accelerated. Quality companies were also where you wanted to be invested, and over time there's a focus on that. And that's why we're not getting caught up at the extreme end of the SPACs and the like in the US market. We also learned that lease agreements aren't what we thought they were. A piece of paper with people committing to invest in, to pay rent over a time period. When things go awry, if they can't pay, you're in for a bit of trouble. We also got reminded that fear and greed is alive and well. Ultimate fear in March saw the market down 35% globally, and greed saw the market up 60 to 70%. And those characteristics you always have to take into account when constructing a portfolio. But our formula over time is to buy shares in companies that we back, and there we mean high returns and good growth at reasonable prices that we're happy to own through market cycles. So that philosophy and formula worked very well again in 2020, and we certainly will be sticking with that. And then just a reminder why we love equities. We wake up in the morning excited to try and find the next investment opportunity and to follow the businesses that we like. So there's companies out there that are changing the world and whose futures are very, very exciting. The 5 that spring to mind is Disney. On the slide on the right-hand side, I show that at their April 2019 Investor Day, they projected 90 million Disney Plus subscribers by 2024. They achieved that by December last year. At their Investor Day in 2020, so a month ago, they increased that forecast in 2024 from 90 million to 260 million. All of the Disney properties are now looking at 350 million subscribers by 2024 from 100 million today. So you can sit with a lot of comfort, invested in a business where you know that kind of growth is as close to guaranteed as you can get. As Henry said, Facebook, there's 65 billion WhatsApp messages a day with no revenue, and that will become monetized. With Amazon, global e-commerce penetration is still only 16%. Chegg, our education play, we think you'll see dramatic differences in elite tertiary level education over the course of the next few years. My son spent his first year at GCT last year. He was physically there for 3 weeks and spent the rest of the time online. And all of you will have had similar experiences. And then something like Spotify and podcasting, we think will start to change and take over from radio advertising. And there you've got the potential to go from 1 billion in 2021. The radio cake at the moment is 37 billion that it'll start to penetrate. So you want to have some of your money exposed to companies that are taking advantage of the massive changes in the world. The other point to remember is that not everybody can be a winner. And when you're in a rampant bull market, certainly on the tech side, as Henry said, there's a lot of shares that haven't really participated in it. Everything is being priced as a winner. And that's why we think it's increasingly dangerous to take your exposure through ETFs and passive investing. It's becoming increasingly important to pick the winners. I was watching CNBC last night, and one of the participants said, "Dear friends, do not make decisions based on valuations." That probably worked last year, because ultimately the companies that did really well, if the business fundamentals are good, the prices ran hard. But we certainly always use valuations in our assessments, and it's an incredibly part of a long-term philosophy in order to get returns. So the real driver of markets is effectively earnings growth. And here you can see the S&P in 2020, earnings were down about 20%, about 18 to 20%. We're looking for a recovery of about 30% next year, and still excellent growth in 2022, because as you can appreciate, there's a lot of US companies that are still battling right now, and we think in a year's time we'll be back to normal. From a global assets perspective, what this chart shows is the return range. So you can see we're projecting 5% in dollars return from global equities, but the range is plus 20 to minus 30. So depending on the global recovery, and a lot of that will be based on COVID, we think the market from here can actually run a lot more than 5%. That's what happens in a bull market. It gets beyond valuation ranges, but we caution people and we watch very carefully. If there's a proper second wave and vaccinations aren't what we thought they were, there's a fair bit of downside. From a local asset perspective, we think the range is a lot smaller. So we're talking about 11% odd from domestic equities, but the drivers of it and the valuation, particularly of the South African market, means that we don't think there's nearly as much downside as global markets. And the dynamics of these types of portfolios and ranges are what we encompass in portfolio construction. What's very important for us and what we're watching on a daily basis is Israel. So Israel has got a small population, about 9 million, and they've been the most proactive in securing vaccinations. They now, as of yesterday, sit at 26% first dose vaccinated, and it's possible that within 2 months, everybody that is going to get a vaccine would have got at least a first dose, and a lot of them a second dose. So we've got to watch very carefully to what this does from a virus point of view, and it gives us a clue, almost a trailer of the vaccination impact around the world. Only yesterday on Business Insider, a headline saying Israel is warning that a single dose of the Pfizer vaccine is less effective than we hoped against COVID-19, and it could be a blow to the US and UK strategies. We're not panicking with every headline. There's going to be a lot of headlines. There's going to be a lot of news. We think human ingenuity will conquer this vaccine, but it possibly won't be the smooth ride that the market is predicting. The big risk factor from a global perspective that everybody's highlighting is US inflation. If inflation kicks up, yields are likely to kick up. And as Henry indicated at the beginning, a big driver of what's happening in markets is the fact that money is so cheap, rates are at zero, and you're forced into the risk curve. I thought it was quite illustrative to give you some comfort from a US inflation perspective. And what this chart shows is the South African CPI basket and the US PCE basket. What's scaring a lot of people is that food prices and commodity prices are really on a tear, and how that will flow through to inflation. Importantly, in the US, it's a services economy. And because so much value is added to product, the actual food and commodity price impacts are not that big. So if you look at food in SA, it's about 16% of our inflation basket, whereas in the US, it's only about 6%. The biggest contributor to the US CPI basket is health, which is about 22%. And inflation in that has only been growing at 2% per annum. And we think Biden will certainly institute regulations to put that under pressure. The second biggest is housing, which sits at about 16%. And the actual housing number, which is really kind of an owner equivalent rentals, has tended to not go up dramatically. So that's some comfort and some picture of what US inflation is determined by. But you don't need to be concerned that commodity prices will flow through and kick that up. From a South African market perspective, interestingly, the South African market has actually outperformed quite nicely since October. As we said, it's global risk on. It flows through into lots of money available, people going into emerging markets, and especially commodities. So cyclicals and value stocks continue to outperform, and we see that continuing. The market is certainly looking through COVID, so that's a factor that we're very aware of. And South Africa is primarily driven by emerging market factors. So money flowing through into emerging markets by default means money into the South African market. And that's where you've seen quite a nice kick, even in our SA Inc. shares. More specifically to the JSE, commodity prices are firmer. We're quite bullish on NASPERS and process this year, and a cyclical upswing in domestic growth, creating pockets of opportunity for alert management teams. We've got to try and assess what the impact of this will be. This is Google's mobility graph for SA lockdown 2.0. If you look at the green line out and about, you see that bottomed at 90% down at the height of COVID in April last year. That got back to normal, in fact, in early December. So things do normalize when conditions are conducive. We're now sitting at about minus 36%. Then looking through into equity performances, a year we're very proud of in 2020. These are kind of our 5 different unitized or model portfolio equity plays. Our global equity fund did a remarkable 91% in dollars last year. And according to the surveys that we look at, was one of the top 10 funds in the year last year. That's the top fund in South Africa over 5 years. And in the fund manager, Nick Dennis, you've got a guy whose philosophy is to try and find multi-baggers. So he's got a lot of the companies of the future, and you simply have to have in your portfolio some exposure to the businesses of the future. And we can think of no better place to get that exposure than our global equity fund. Likewise, our global technology fund, it was a top 5 global fund in SA in 2020, 54% in rands. That's focused purely on technology shares. And Henry, you heard talking at the beginning, is one of the drivers of that. So we think, across our global equity and global technology, you get very nice exposure to the businesses that are changing the world and businesses that are leveraging off the massive changes in the world. Our more conservative and more traditional high street equity model portfolio gave a return of close to 25%, and over 5 years is the number 2 performance in South Africa. We then, we've indicated that there is a fair amount of risk out there in markets. We're maintaining our exposures. It's a bull market, but at the same time, the hedge category, I think, is coming back into the fore. In South Africa, we had the top long-short hedge fund in South Africa last year. It did about 30%. Sorry, that was in 2019. It won the award for that. And again, last year, delivered an 18% return. So if you're looking for an investment which doesn't have the same kind of risk profile, it's much lower risk than a pure equity portfolio, we're certainly seeing our clients embrace that. From a local equity perspective, it was much more difficult to make returns. The market was roughly flat. Our equity fund was down 1% odd, but we've already seen a very nice rise in 2021. And that's got a fantastic performance since inception. This is just an interesting graph and one that we love showing. This is basically the global equity funds with their rand returns in South Africa. Unfortunately, due to regulation, we can't tell you the names of those funds, but the information is quite freely available. And what I've circled there is the number 1 and 2 return portfolios over the last 5 years are the Anchor Global Equity Fund and our High Street Equity Model portfolio. And there you can see our Global Technology Fund coming in at number 5. Right, so in South Africa, to quickly go through it, commodity prices are booming. What we show here is the spot commodity prices versus the average of last year. So rhodium at the moment is 64% higher than the average of last year. And these are already high prices. Iron ore trading at well over $150. There's some producers out there that produce iron ore for $20. So massive cash flows coming through in these companies. And, you know, we keep on asking the question, after pretty good performance, are the mining shares still cheap? What we've got in the kind of brown line is the consensus PE multiples for mining companies, which seem pretty reasonable. But if you put current spot prices into them, these companies are very cheap. In other words, we don't need commodity prices to carry on charging upwards. If they simply stay where they are, the cash flows that these businesses are generating is phenomenal. You can see, for example, Anglo-American, if iron ore stays where it is, if copper stays where it is, it's on a 6 times PE multiple. Platinum could be the real positive surprise. A company that I've got a slide on coming up is Sibanye. At the current platinum, rhodium, PGM basket prices, it's on about a 3 PE multiple. And likewise, pretty good valuations for the others. The slide that I like to use often, I'm not going to go through in the detail, you're all welcome to have a copy of this presentation. The South African earnings growth over the next 5 years, we think the base case is about 6% per annum. So you have to be selective, you have to be in the right companies at the right time, but it also means that we think it's very important to have global exposure. The South African market is cheap, so it's a very different story to the US market. We're looking at the brown line is emerging markets, the blue line is South Africa. So if the current flow of money and a risk-on environment continues to flow through into South Africa, there's certainly some room for increases. Infrastructure is a very interesting story in South Africa. And I'm going to ask Stephan Engelbrecht just to talk for 2 minutes. Stephan's part of our fund management team on the prospects for the infrastructure sector in SA.
Cool. Thank you very much, Pete. And thank you guys for the opportunity to have a quick chat with you on infrastructure in South Africa. So the new economic plan for South Africa and the economic reconstruction and recovery plan was unveiled by President Ramaphosa in October 2020. Now, although this plan did not provide any new ideas to grow the economy, we actually believe that this plan may be more successful than its predecessors, and we had quite a few predecessors before. The big difference this time is that where the predecessors basically just gave a wish list of grand ideas, this plan rather went and prioritized certain projects and, as far as possible, gave measurable outputs that must be achieved over time. And infrastructure investment was priority number 1 of this new plan. Now, infrastructure investment is a very good path to pull an economy out of a slump. Not only is it labor intensive, which will assist in reducing the unemployment rate, but it will also facilitate future economic growth. The proviso here is that the investment is made into projects which the economy actually needs to grow. I think we can all agree that the soccer stadiums for the FIFA World Cup probably did not manage to meet this proviso. Most of the plan's infrastructure investments are allocated according to 3 main sectors, namely energy, network industries. These will include road and rail networks, ports and public transport, and then social upliftment. This is already a significant improvement from soccer stadiums. But can the government implement all of these ambitious projects? Well, speaking to industry participants, the feedback that we have received thus far is quite encouraging. On a conference call with the bankers preparing the documentations for the Renewable Energy Bid Window 5, which, by the way, will be larger than all the previous bid windows combined, they were very complimentary around the government's willingness to engage with the private sector and turning from the driver of these projects to the enabler of these projects. On a conference call with the management team of listed construction company Robex, we noted that they were optimistic that the scheduled projects will come to realization. They confirmed the improved engagement between government and the private sector and noted that contracts are finally being awarded by most of the government agencies they engage with. Recently, Robex announced that they have been awarded 2 multi-billion contracts from Sunrail, who has been out of the market for almost 5 years. Given the dire state of the SA economy, the lack of urgency is still excruciatingly frustrating to us. But it does appear as though the wheels are turning slowly. This is a theme that we have not yet pulled the trigger on aggressively, but it is one that we are watching with interest. It is still early days and much can still happen to upset the apple cart. But if the investment drive comes to fruition, it can be a real boon for the SA economy and in particular for construction companies like Afrimet, Robex and Wilson Bailey Homes. Cool. Thank you, Peter.
Thanks, Stephan. So that's certainly a very interesting play, one that hasn't really pumped in South Africa yet, but something that we think has got some upside potential. But then looking deep under the hood from our perspective, and this is into our SA Equity Fund, we just wanted to show you the kind of diversity. And when you buy one unit in one fund, you don't know what's under the hood. And you can see a nice mix in that portfolio of good quality South African companies, some resource businesses, Chinese ETF, a great global business that it's pumping at the moment called ASML. But I think importantly, to look at the top right-hand side, and this is the key measurement that we use all the time. So if you buy into our equity fund, you're getting 26% exposure to South Africa Incorporated. I think often when people talk about South African equities, they assume that it's SA Inc., but we're only sitting with about a quarter there. About 21% exposure to resources, 11% to Rand hedge, another 23% to offshore, and 16% to NASPERS. So to quickly run through some interesting shares, SIBANYE-STILLWATER, if you look at their debt numbers on the left-hand side, they peaked at $25 billion debt. Everybody was very nervous. The company is now generating 40 billion plus in cash flows at the moment. And you're only paying about 3 times that. And we love a company like BIDCORP. We think it will get back to the business it was pre-COVID when COVID is over. It's a global business, lots of exposure to Australia and Asia when things are getting back to normal a lot quicker. So this share was 350 Rand a year ago. We think it can well be 400 Rand in another year's time and currently sitting at 280. MTN, the telco space, is at a fantastic year globally because as you'll appreciate, demand for telcos has gone up significantly, data and the like, but simply because of its Nigeria exposure, the share price has done horribly. We largely judge Nigeria. The biggest driver there is the oil price, which is positive. So there's a lot of Nigeria risk there, but you're not paying for that. And this is a 65 Rand share that we think is worth well over 100 Rand. You can't really do an SA equity presentation without talking about NASPERS. Bottom line is the 10-cent part we think will grow its earnings at a compound 25% per annum for a few years to come, which is absolutely amazing given that it's one of the top 10 businesses in the world from a market cap perspective. And then the NASPERS rump, the non-10-cent stuff, the earnings profile that you can see on the right-hand side is very strong and we think will add to the whole equation. Interestingly enough, if the non-10-cent businesses in NASPERS were listed today, which is classifieds, payments, e-commerce, and a few others, we think those individually would all have done fantastically well. The NASPERS discount is now around the 50% mark. So you're buying this business at half price. And I think people have been bored by the story and have forgotten that management has actually put things in place to unlock this discount, and they're waiting for regulatory and tax approvals. So I can't tell you when, but we're very comfortable to own this business. And at some stage, without warning, there'll be an announcement of some kind of unlock, which would provide a further kicker. So guys, that's the summary of where we think the money will be made. Domestic equities, 11% for the year, but the current trend is certainly higher. Likewise, globally, we're in a bull market and we're certainly not getting off that train. In our segregated portfolios, we are starting to take a bit of cash, but 5% by year end. Domestic fixed income, a yield of 6 to 10% means buy bonds and be patient. Not be patient, be patient. And global fixed income, avoid duration, hold a corporate bond for 2 to 3% yields. So we're in a bull market for now. I think we've given you all the perspectives. We're hanging on to the story, but I think a very clear message that as investors and custodians of your capital, we're treating it with caution. And, we certainly are trying to find the shares and companies that still offer some value.